Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what I can do to offset the risk of being naked, so we all know that when we sell a put option or a call option for that matter, without the underlying security or without, in this case, not the underlying security in the world of stock trading, but without some other option contract offsetting some of the risk, the position is referred to as being naked. In other words, there's an unidentifiable risk exposure. So what we can do is, once again, we can go in and we can say, all right, I really like the premium that those 98 or 97.50 or 97 strike puts are giving us, but I need to create some some protection on the downside. So what do? We sell our puts at the 98, we collect a premium, we use some of that premium to buy puts at a lower strike. And the idea is that the strike price selection here with respect to where we're buying off those, or buying those puts, it's selling the at-the-money puts and buying the out-of-the-money puts, is really going to be dependent upon how much risk we want to expose ourselves to. At the end of the day, our risk when we create this bull put spread is limited to the spread differential between the strikes minus the premium. Now, the wider the strike prices, the more of the higher strike put premiums we're going to collect. The closer, of course, the less money we're going to get to keep, because we have to put that out to buy these out of the money puts. But at the end of the day, our first objective is to identify a level where the market or the pair is likely not to break below, write those options first, and then ultimately buy some of those options at a lower strike price in order to identify our risk exposure. And this has a number of different benefits. One benefit, of course, is that we don't have to worry about margin requirements, except for the, of course, the difference between the strikes, which is certainly a consideration for smaller account sizes. So a larger account size may say, I'm just going to sell puts below that support level. A smaller account size may believe that it would be best to create this bull put spread. Now, the two strategies that I just showed here, although we're using put options, are ultimately bullish strategies. So we can also use our charts to identify if the market is in an uptrend, and we can sell put options or create bull put spreads as long as the market is in an uptrend. Now, we can also use the same observations with respect to selling calls. So here I'm taking a look at the CDD, which is of course the U.S. dollar versus the Canadian dollar, and my observation is that we can see there's a resistance level at that 100 point. So the rationale here is that I can sell call options and I can collect a premium, and as long as the pair value remains below 100, which we can see clearly that it has over the last couple of months not been able to break that level, then I'm going to be able to generate some cash flow as those call options expire worthless. So once again, what we're ultimately looking to do is to capitalize on the identification of this resistance level. We're going to write options outside of that resistance level at a higher strike, because those options, number one, we recognize that the charts have a high probability, or in this case the chart is telling us that there is a high probability that the CDD is going to come up to this level here and likely consolidate or reject. But at the end of the day, we have a little ways to go before we hit that, and ultimately we're looking for those calls to expire worthless. Now, we can create that same rationale with respect to limiting our risk exposure by identifying an area where we could buy call options to limit our risk exposure. So in this case, we're going to apply the same observations with our that we did for selling those naked calls, whereby we want to write those 100 strike call options above that resistance level, looking for them to expire. But we're going to go out and we're going to identify a higher up strike price, and we're going to buy call options at those upper levels there. And what that's going to do is that's going to limit our risk exposure between these two support and resistance levels. So ultimately, if we do happen to see the CDD break above that 100 level, that we have an identifiable risk exposure to the extent that we've written that upper call option. So in this case, we would have a 2-point risk because, as you can see here, we've bought the 100s and we sold off the 102s, and then we would subtract our premium, and then that becomes our risk exposure. Okay, and all we're doing here, you'll notice that we haven't once necessarily went into the options chains. What we're doing is we're establishing a roadmap to trading these FX options by simply identifying some very important support and resistance levels on our price charts. Now, if we talk about the consideration, I talked about the idea of utilizing or applying an iron condor. One of the conveniences that I suggested back at the beginning of being able to identify what kind of a market we're in, whether or not we're trending up, trending down, or trending sideways, is that there are a number of option strategies that allow us to capitalize on a sideways trading market. And so what we have here is a chart on the AUX, so the U.S. versus the Australian dollar, and we can see that once again over the past couple of months, there's been a very well-defined support level at 98 and a very well-defined resistance level at 102. So we know that ultimately we could sell call options above 102, collect the premium, and if the pair stays below 102, well, we keep that premium. At the same time, we know ultimately, if the pair is trading below that, we keep that premium. We also know at the same time that we can see that the AUX has also been maintaining a support level at 98. And we know that if we sell off any put options below 98, as long as the pair stays above 98, those puts will expire worthless, and we'll keep those that premium as well. So realistically, what we can do is we could basically sell calls above 102, sell puts below 98, and capitalize on this sideways trading market. Now, that's going to have a certain amount of risk exposure as both of those positions are naked. So what we could do is we can just take this strategy one more step further, and we could ultimately sell those put options, but we could create what we know as, of course, a bull put spread. So we're going to sell those puts at 98. We're going to buy those puts down at 96. And ultimately, we're going to be able to capitalize on collecting of the premium. Now, at the same time, we could sell off those call options above 102 and buy the call options, let's say, up at that 104 strike. Once again, minimize our risk exposure and capture a premium that ultimately, if the pair value is trading in between those two written strike calls and the written strike of the puts, we're going to make our money. Now, the idea is that we can only be wrong on one side. So if AUX rallies above 102, well, we're going to feel some heat on that particular credit spread. But we recognize that this credit spread, the put credit spread, is going to expire worthless. If the pair actually drops below 98, well, we're going to feel some heat on those short puts, but we recognize that these long puts, or the short calls, are going to expire worthless. So we can really only be wrong on one side of this particular strategy. So this is what's known as an iron condor. It's really simply a bull put spread down here, looking for the pair to stay up, and a bear call spread looking for the pair to stay down, combined together. And ultimately, as long as we see the actual pair value consolidate between 98 and 102, and as long as it remains between that range, between now and ultimately when it is that of the expiration date that we've selected, then we're going to make money on both sides. Now, just a great question from Tina here is, are we talking debit or credit? Well, these are credit spreads. So the idea is that what I did, if we go back and we sort of talk about how this strategy was put together, and I've got a couple of minutes that I can take here. We're talking about identifying a resistance level up here at 102. And when I talked about selling call options, because remember we're talking about options writing, I said that, look, if this pair stays below 102, I can write those 102 call options, collect a premium, and at the same time, if I believe that the puts are going to that the pair is going to stay above 108, I can sell off the 98 puts, and as long as the pair stays above 98, well, I'm going to collect that premium as well. But the problem is that although we collect full credit for both of those particular option rights, we have an unlimited risk exposure on either side. So in other words, I've created an obligation by selling these 102 calls to deliver anywhere, to deliver at 102 no matter how high the pair actually goes. Now, even though the FX options are cash settled, I don't want the AUX to be trading at 110 and I have to cover at 102. I'm going to lose 8 points. Similarly, I can write those 98 puts, but ultimately, if the AUX continues to the downside, heck, we might be down at 93, 94, which means that I have an obligation to buy at 98, but I can't cover until the lower, basically I can only cover at the lower strikes, and that means I might be at risk, 4 or 5 points. So what we do in order to offset that risk, we sell the puts and we buy some puts and we identify our risk exposure to within 2 points. So we collect less credit, we still collect the credit. We then sell the calls, but then we limit our risk between the 2 points between 2 points between 102 and 104. So again, we give up some of the premium that we collected with those calls, but ultimately we've identified our risk exposure. Once again, what we're looking for is as long as the pair stays within this 98 and 102 range, we are looking at capitalizing on both of those positions expiring and collecting full premium. Now, the one question is, would this be a trade that we would want to do when volatility is high? Well, sure you can. I mean, we can. One thing that you have to understand is that options writing is still a great strategy when volatility is low. You're just not getting the same amount of premium. So I wouldn't necessarily say that I would only want to apply this strategy during times when implied volatility is high. On the contrary, I think that ultimately looking at using options to generate cash flow, we just have to recognize that some months we get paid a little more for assuming the risk. Other months we get paid a little less. At the end of the day, yes, this trade benefits. It's an option selling strategy. These are option selling strategies. So when we're ultimately looking at selling those option contracts and then offsetting the risk with the upside premiums or the downside, or sorry, the upper strike calls or lower strike puts, we have to recognize that we're giving up a little bit of profit. But at the end of the day, we're still looking to generate cash flow. Now, there's lots of different ways, guys, that you can participate in this kind of these kinds of observations. There are many different strategies that you can implement. The important consideration here is, how do I use these price charts to identify a particular trading range or a particular trend that's in place, and ultimately, what is the most appropriate strategy, and remember, we have a lot of synthetic strategies available to us as well in this market. But ultimately, what we want to do is just use these price charts to identify whether there's a trend in force, whether the pairs are consolidating, et cetera, and then move on from there to ultimately select an appropriate strategy and then appropriate strike prices. the market makers work very hard. There's just a quick question on liquidity, and I'm sure Steve can speak a little bit more to this as well. But these option contracts are quite liquid. The market makers actually do a great job to ensure that there's significant liquidity in these markets to make it attractive for us lowly retail traders to participate in. And guys, you can access this particular market and the pair values through any standard brokerage account. So the idea is that if you've never utilized or number one any of these strategies or have never traded any of these ISE FX option pair values, most brokerage platforms have a simulated trade platform available. So get in and click a few buttons and ultimately see how these pair values, how these FX options fluctuate based on the ebb and flow of the underlying currency markets. So, guys, on that note, just a quick. I want to point out very quickly that there's a number of webinars throughout the month of February and March. I just put up a list here. You can see that we can see that there's a couple of really interesting strategies that and observations here that you guys can get in on here over the next couple of weeks. The other comment that I would make, and it kind of answers kind of Chris's question, is the www.fxoptions.com is a great place where you can find a ton of information, a ton of quotes, all of the charts, everything that you need in order to just kind of get in and navigate your way through the FX options market. Options Express has these FX options available. Interactive Brokers, Thinkorswim, any of your major standard brokerage platforms have this market available to you. You just need to understand the symbology and then get in and click a few buttons to find them. But retail traders can really find these options anywhere where you're trading index and equity options. You can find these FX options available to you. But www.fxoptions.com, lots of phenomenal information there. I'll tell you, this site is unbelievable. Don't just take my word for it. They've done a really, really amazing job. It's a really cool site. I can't tell you anything more than that at this point. So, guys, final point. We're actually running an online workshop tomorrow at noon and actually Thursday at 6. And so we'd love to have you guys come in and see a little bit more about what it is that we do. We focus on options. We focus on currencies. We focus on futures. And one thing that I can tell you, and this is, this holds true in the day-to-day education that we provide. I'll tell you, to be a multi-asset trader is fantastic. And I said earlier on, one of the strategies that we recommend to a lot of our currency traders is, hey, you know what, you might like to generate a nice little paycheck on a day-to-day basis, trading 1 minute, 5 minute, 15-minute charts in the spot market. But nothing works more effectively for trading a directional view than getting in and buying a 4 or 5 months FX options contract here and just sitting back and recognizing you have a limited downside exposure, but can take advantage of the upside depending on your directional bias. So, guys, hopefully this gives you a little bit more insight into how you can make effective decisions trading. When you're looking to participate using FX options. Really these kinds of observations apply to all different asset classes, but very, very powerful. For those of you that are just simply using your fundamental prowess to make decisions, I'll tell you, adding a set of price charts to the mix really takes your trading and your decision making to the next level. Remember, these price charts, you're designing a roadmap for your trade, and without a roadmap, it's very easy to get lost. So on that note, I'm going to wrap things up, Steve. Again, sorry everybody for all of the technical hiccups that we had throughout the day. Hopefully we're able to, or throughout the session, hopefully we were able to deliver the message. Our power's back on now. We are back in business. So Guys, any questions, I'm available, Jason at optionsource.net, or please visit the site, find out more about us, and love to see some of you guys online either tomorrow or on Thursday at 6 o'clock. Of course, that's Eastern as well. So, Steve, thanks very much for the opportunity, and I know Patrick is joining you later on today. Just so you know, he actually rushed out to go home just in case the power didn't come back on, so he's settling in at home now to make sure he can deliver without interruption for you.
Jason, thank you very much, and I do apologize for any inconveniences that you had.
Oh, no worries. It's the nature of the beast sometimes.
Yes, that's true. But you worked through the adversity. Thanks again.
Good
and
stuff.
When did you say that online workshop is? Tomorrow,
well,
Jason?
we have two. We have one running tomorrow at 12 noon Eastern, and we actually have one running on Thursday at 6 p.m. Eastern. And all of the information's on the site at optionsource.net. And I think it's just a great way for people to see, and I'm sure you'll attest to this as well. You know, the more versatile we can be, and this is by FX options, we feel plays such a huge role in any solid investment approaches. You know, the more versatile we can be, the better understanding we have of all the intermarket relationships, the more effective we can be. That's what we're looking to deliver tomorrow and Thursday as well. So it'd be nice to see you folks out. Actually, I see some names that I know are already registered. So the door's open for anybody to join, and yeah, we'd love to see you out.
Jason, thank you so much on behalf of the IC. Really appreciate it. And I do hope that everybody checks out the optionsource.net workshop tomorrow or Thursday. Please go to optionsource.net to sign up. Thanks again, Jason.
Thanks a lot, Steve. Always a pleasure, and all the best, and all the best to everybody as well.
Thanks, Jason.
Take
Just want to
care.
remind everyone that Jason's partner, Patrick Seresna, will be with us in just 30 minutes. So you have to log out and log back in because they're two unique events. But if you're interested in learning more about optionsource.net and learning a little bit more about ETFs and how Patrick uses ETFs, please join us in 25 minutes as we're going to start a new presentation. So again, thank you. On behalf of the ISC, Steve Meisinger, wishing you a safe and happy trading day tomorrow. Thanks again, Jason Ayres. Really appreciate it. Take care now, everyone. Bye now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.